Oil traded above $105 a barrel on Friday, roughly 50% higher than before February 28th. The U.S. military struck 2 Iran-flagged tankers in the Gulf of Oman the same morning. Secretary of State Marco Rubio said he expected Iran to reply to a peace proposal later in the day. Those two facts should not coexist, and the market's inability to price them cleanly is the real story of this week. The Strait of Hormuz has been effectively closed since the war began, cutting off the passage through which 1/5 of global oil normally flows. That closure has already produced a measurable economic chain reaction. Maersk, with handles 14% of the world's containerized goods, disclosed an extra $500 million in monthly fuel costs and told investors it cannot absorb all of it. Customers will carry a share. Goldman Sachs analysts wrote that if supply disruptions continue, elevated oil prices could persist through 2027. That window matters because it is long enough to change how the Federal Reserve has to behave. The Fed connection is the mechanism most investors are underpricing. St. Louis Fed President Alberto Musalem said this week that risks have been shifting toward the inflation side. Average U.S. gasoline prices hit $4.48 a gallon as of May 5th, up from $2.99 the day the war started, a 50% spike in roughly 2 months. That acts as a regressive tax on lower-income households, compressing discretionary spending and threatening the consumer base that companies like McDonald's and Domino's rely on for same-store sales recovery. If those two forces, inflation above target and softening consumer demand, land simultaneously, the Fed cannot cut rates to defend growth without fanning prices further. Iran's own economic collapse adds a layer that markets typically treat as exogenous noise, but shouldn't. First Vice President Aref acknowledged that some prices jumped more than 100% in less than a week. The rial hit an all-time low of 1.8 million to the dollar. The regime is paying wages and food subsidies from a collapsing fiscal base. That pressure is the most credible source of a genuine ceasefire, not diplomatic goodwill. The closer Iran's government gets to an inability to make payroll, the higher the probability of a deal. And a deal has an immediate, quantifiable market consequence. Oil back towards $70, jet fuel costs down, airline stocks recovering, and suddenly the Fed's inflation calculus shifts the other direction. The question is not whether a peace deal is possible. It is whether the timeline fits inside the window where inflation expectations can still be re-anchored.
The same week, Maersk warned of demand destruction from high fuel costs. 3 memory chip companies reported results that seemed to belong to a different economic era entirely. Micron surged 11% Friday on cloud memory business unit revenue of $5.28 billion at a 66% gross margin. SanDisk amped 11% on quarterly revenue up 251% year-over-year. Western Digital rose 3% after its non-GAAP gross margin crossed 50% for the first time. That divergence, collapsing shipping profits, exploding memory margins, is not a contradiction. It is a structural split in where AI capital is flowing, and it explains why the VanEck Semiconductor ETF has gained 50% year-to-date, even as the broader economic backdrop carries oil shock uncertainty. The causal driver is high bandwidth memory, or HBM. Every large language model, every AI inference workload, and every agentic pipeline requires HBM sitting adjacent to the GPU. Supply is structurally short. Micron's order books reportedly stretch into 2027. Analysts running 39 buy ratings against 5 hold calls on Micron stock have a forward price-to-earnings ratio of 6x, implying an earnings ramp so steep that even after a 151% year-to-date gain, the stock looks cheap on a 2-year earnings horizon. The counter-signal worth watching is hyperscaler capex. Micron, SanDisk, and Western Digital all derive the bulk of their revenue growth from a small number of cloud infrastructure buyers: Amazon, Microsoft, Google, and Meta. If any of those buyers signals a pause or reallocation of AI spending, which Microsoft faces pressure on, with hedge fund TCI reportedly cutting its stake over AI disruption concerns, memory demand could soften faster than production capacity can be wound down. The historical pattern for memory is sharp upcycles followed by sharper corrections. What is different this time is that capacity discipline among producers appears more measured than in prior cycles, and the AI infrastructure build-out has a structural demand floor that commodity memory never had. Whether that floor holds at current price levels or whether it is already reflected in a 528% year-to-date move in SanDisk is the threshold that determines whether this trade still has room or is already pricing 2027 perfection.
Apple reached a preliminary chip-making agreement with Intel on Friday, and Intel stock jumped 19% to an all-time high. That single headline resolves a question that has quietly been building since Apple moved its Mac processors off Intel's x86 architecture in 2020. whether Intel's costly pivot to foundry manufacturing could ever win back the kind of customer relationship that once generated billions in annual revenue. The deal's significance runs through Apple's supply chain logic, not Intel's balance sheet. Apple's consumer chip production is almost entirely concentrated at TSMC. As demand for Apple Intelligence features drives higher memory content and faster silicon refresh cycles, management flags significantly higher memory costs ahead. That TSMC dependency becomes a supply constraint, not just a vendor relationship. Analyst Daniel Ives at Wedbush raised Apple's price target to $400 from $350, estimating that roughly 20